Hello to all our clients and investors. Here we are in March already. Our global economist, Chris Watling, will be joining us soon from London, giving us a snapshot of the current market sentiment and some new recommendations. Chris will be talking about the recent pullback in the markets. In fact, we're in the second longest bull market on record. The only longer one was between 1990 and 2000. Chris is saying that the market has experienced an over-enthusiastic sell-off, but he expects the market rally to continue. His themes are that we are moving away from synchronised growth globally, with China and Europe softening and the US and Japan taking up the slack. We have adjusted our client model portfolios recently and have gone overweight in technology stocks, with an increase in the Nasdaq and the S&P 500. Here is Chris with his monthly snapshot. If you want the full detail of the monthly allocation, then please email me at russell@financialchoice.com.au.
Great, lovely to speak to you all once again, following our video earlier this year for Financial Choice. Back a few weeks ago, we talked about the discussion in markets in January. Everyone was obsessed with the idea of melt up, and we threw out the idea that perhaps exuberance was getting a little bit carried away in the short term, and there was every chance we'd get a period of consolidation or indeed some give back in equity markets. Well, here we are several weeks later, early March, and of course we've seen two bouts of selling in equity markets, one in early February and then again in early March. The first, of course, being ascribed to a high wage inflation print on the non-farm payrolls out at the beginning of February, and the second sell-off being ascribed to Trump's implementation of tariffs. Of course, though, this really is a false narrative, and one just needs to analyse the data to demonstrate that of course, that the market started rolling over on the 23rd to the 26th of January, and the wage inflation data print came out on the 2nd of February, by which stage they already started rolling over, and they, of course, then continued to roll over when that data point came out. Equally, the tariffs, how can we say that markets are selling off because of tariffs? Trump's been talking about those since the day he got elected, or indeed before that. In fact, I remember back in January 2017, as he hit office, during the course of that month, there was an expectation of executive orders would be implemented immediately, putting tariffs into place. But of course, the market didn't sell off in anticipation of that, as you would have imagined. So I think it's very difficult to be specific and look backwards and bring about the narrative that supposedly has created any sort of pullback. What one does is really look at the positioning in markets, look how exuberant they were before the pullback, and look at them now. And if we look at our measures of exuberance, or indeed our measures of risk aversion, in the very near term, markets are pretty oversold, pretty beaten up, and pretty risk averse. Investors are starting to get quite fearful about this sell-off that they see. And of course, that's actually a very good contrarian signal, because the best thing you can do in markets is lean against sentiment. The more you hear of fear, the more you should be greedy. The more everyone's greedy, the more you should be fearful. So in terms of trading those short-term moves in markets, I think we're increasingly getting to the level where global equities are attractive, should be stepped back in. I think the trend is a cyclical bull market, and it's simply a case that we've had a bit of a washout of over-exuberance in markets, and we'd expect this rally to resume. Now, having said that, I do think it's important to bear in mind that there are some themes evolving in the global financial and global economic landscape, and these are new themes. We've been running a global theme really of reflation across the globe since the major lows in equity markets in February 2016. And that reflation, of course, was led by Europe and China, as China reflated aggressively and Europe picked up that wind of global trade growth, and the US was sort of chugging along nicely as well. That, I think, is a narrative that's just starting to change in markets. And it's starting to change in that we're moving from this global synchronized growth narrative to a narrative where I think we'll see growth rates in China and Europe soften, and the US take up the baton of global growth leadership. And I think that'll have big shifts on currencies. That'll encourage a stronger US dollar. That'll have big shifts within stock markets. I think the classic deep cyclical, resource type sectors will start underperforming, deep industrials will start underperforming, and we'll start seeing outperformance from other parts of the stock market and continued outperformance from tech, as we've seen over the last year or two. And I think also it'll have implications for bonds and across your whole global asset allocation sway. So I think that's a very big theme that's coming into play here. I think it needs to be watched closely. The data's starting to demonstrate it. Taiwanese exports very weak overnight. South Korean exports weaker a couple of weeks ago when that data point came out. And some PMIs in the manufacturing world starting to roll over. So it doesn't preclude an ongoing cyclical bull market. We still believe very much in that. And as I mentioned at the beginning of this video, this latest bout of volatility is providing another opportunity to put money to work in global equities. But it does mean that you have to be careful about how you asset allocate within that global equity bull market and within global asset allocation. So keep an eye on that, watch that closely, start favoring a US biased tilt to portfolios, but remain overweight global equities in aggregate. Thanks very much.